Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klein and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this episode of the i3 podcast, I'm speaking with Linda Cunningham, who is the head of Debt and Alternatives for Cbus Super. We talk about some of Linda's core beliefs when it comes to debt investing, including the Banking 101 rule to be very careful when borrowing short and lending long at the same time. We discuss the importance of cash flows and ensuring the ability of a borrower to pay their interest. We discuss liquidity in mortgage funds and private credit funds aimed at retail investors, as well as the occasionally funky fee structure. And of course, we delve into the state of the private credit market and ASIC's recent comments on the sector. We even talk about how Linda once provided a loan to finance a catamaran called the Soggy Moggy. Enjoy the show. Linda, welcome to the podcast.
Thanks for having me, Wouter.
So your journey started a bit unusually compared to maybe some of your peers. I believe you started in the industry when you were just 15 years old. How did that happen?
That's correct. Look, and I'm going to age myself here, but we are talking, the early 1980s. I had grown up, my father was a bank manager, so I had from a very early age been exposed to banking. And by the time I was finishing year 10, I had a decision to make, which was, did I want to go on to year 12? Did I want to go on to university? I knew I wanted to end up in banking. Superannuation funds didn't really exist at that time, but I knew I wanted to get into the lending side of things. And I had the opportunity to actually start work in the local branch of the bank, a different bank to where my father was, and I enrolled to do a TAFE course. So I did a Gosford TAFE, an accounting course, 3 nights a week for 4 years. So once I finished that, I enrolled in doing my degree by, we'll call it remote learning. In those days, it was called by correspondence.
Yeah.
So by the time I was 23, I had been working for 8 years, 3 years in a branch and 5 years in the corporate banking area.
Yeah.
And I had my degree.
Excellent. And I think there was an anecdote where you, even on the school playground, would discuss monetary policy or something.
Well, look, I do remember in a commerce class in year 9 having a debate with my teacher about the difference between a bank and a building society. And apparently I was quoting the Banking Act of 1959 in those discussions to tell him there was a difference.
Right. Not your average conversation, I think, for a teenager.
No, but look, it had been something that had always interested me. And look, I still now, people have various dreams. One of my dreams is always rolling coins.
Yeah.
So, rolling up the 20-cent pieces and 50-cent pieces into the pieces of paper. I can still do that in my head.
Very good. Yeah, there's probably muscle memory comes into play with that one.
Exactly.
So having started relatively young, you've seen probably a few financial crises. I think the 1990 collapse of the Geelong-based pyramid building society was one of them. Can you share some of your learnings from some of these downturns with us in terms of how it shaped your outlook on investing?
And look, that was absolutely a very interesting time to be in the lending space. I had moved from New South Wales to Victoria with my work, and late 80s, everything was booming in property. Everything was booming everywhere, but you also had interest rates pretty high. and the market was very hot, and the bank I was working for had exposure to all of the pyramid associated companies. So there were actually 4 building societies there. And we were actually doing what these days would be called a warehouse loan. So we were effectively providing them, with a loan, 80 cents in the dollar, based on a pool of mortgages. And those loans, the underlying loans, would be some commercial property, they'd be residential, it'd be a whole mix of things. And one of my jobs I got to do was to get on the freeway and head to Geelong every few months and actually sit there and look through the credit files. Wow. You couldn't get them on Excel. You couldn't log into a data room. You'd actually go in and sit there in the premises and look through those credit files. And I think for me, one of the sort of lessons out of that was really how important cash flow is for a loan. If you are, in our case, we're expecting, the borrower, being, say, Pyramid Building Society, to still pay our interest. But, if you've got a pool of loans that are in there that are just secured against a vacant block of land or a non-income producing property, where is the income coming from? Where's the interest coming from to actually be able to pay you? And I think that was probably one of the strongest sort of lessons that I actually had, was really how critical income is. And I would say that was even important if you looked across, the bank's books at that time. And, a couple of other names you've got to mention from that era. You can't not mention estate mortgages, Tricontinental, all of the state banks. Like, I worked for State Bank of New South Wales, which actually was in a pretty good state, but we were probably still in that time whereby we actually had a large proportion of our property-based loans, which were, from an LVR perspective, we had breaches.
Right.
And it was one of those situations where, we actually did okay. Like, those loans were pretty good because the income was still solid on them. The borrowers were still earning enough income from these assets to actually be able to pay their interest. But, they suddenly went from having a loan to valuation of, 60% to 80 or 90%, breaching covenants, etc. Just really because of the rapid change in interest rates in the market and the impact on property values.
Yeah, and I think that importance of knowing where the income comes from and the underlying assets, that sort of carries through time, because I think we recently spoken about a loan, and we won't name any names, but it basically looked like a term deposit, but when you looked under the hood, it was something very different with very different liquidity profile.
Absolutely, and look, that's not a new thing. It has its place. It is just understanding how you're matching what you're doing. I mean, we do construction loans, and generally most construction loans, particularly if you're building, say, an apartment complex or something like that, your only income, your only earnings that come in is when your pre-sales of those residential apartments settle. So you are capitalising interest on your loans. Now, I think that's absolutely fine if you're understanding what you're investing in and understanding what you're expecting out of that investment.
Yeah, and as long as you understand the risk profile, because if you expect a term deposit, then you find underlying assets that have maybe 7, 8, sometimes 30-year maturity rates, then that's quite a mismatch, of course. And it sort of comes back to what I think I've heard you talk about as sort of banking 101, where you basically have said you never borrow short and lend long at the same time. Can you explain a little bit that philosophy and how that comes back today in your approach?
I mean, when you think about banks or any form of money lender, the reality is you need to raise your funds from somewhere, and then you're lending it out. And most organisations, or most of those structures, banks in particular, I mean, banks raise funds from long-term capital markets. They have equity in place. They have subordinated debt in place. They have term deposits from people. But they're consciously thinking about the overall asset liability matching. And I think that's, that classic thing. I worked at AXA, so I moved to AXA once I left banking. So I moved there in 2000 or 2001. I was there for over 12 years. So that obviously covered the GFC as well.
Yeah.
And look, AXA had what they referred to as an income. The mortgage funds were income funds. I think it was Australian Mortgage Income Fund. Those funds were providing commercial loans to small corporates. So, they were traditionally the sort of $4 to $20 million sort of size loans. Really good book, really good quality book. There are a few others in the market, like Perpetual, very similar. I mean, probably 40% of the assets in that portfolio were actually your neighbourhood shopping centres, the ones where you've got Coles, Woolworths, your chemist, your butcher, those sort of things. So good income producing assets. But those products were to retail and wholesale investors. And as part of the characteristics of those funds, they did have the ability to have daily liquidity. And that's great until it's not. I mean, there was nothing wrong with those loans that were in that book. And for, the entire life of that particular fund, it had been in net inflows every single month up until September 2008. And then by 2008, you had the Australian government introduced the deposit guarantee. Straight away, that really reinforced for people the difference between something like a mortgage fund or a private credit fund or any other sort of funds. And you've got to remember, these things have been around for decades. You started off with debenture funds and so on. Suddenly realised that it's very different to being with the bank. And look, that fund was frozen in October 2008. We at that stage, we had one problem loan across the whole period of time, one problem loan. But our investors had to wait, 3 to 4 years to actually get their money back because we had commitments in place for loans. And often loans will repay you early, but you got to remember it's also GFC. It's hard to refinance, so borrowers weren't going to repay you back early unless they wanted to. So I think that for me really highlighted that aspect of borrowing short, daily liquidity, and offering a product or investing in something at the back of that is a longer term investment.
Yeah, because essentially to provide that liquidity, then you either have to build in a cash pool which will have a drag on returns, or you rely on new investors coming in, which is of course not guaranteed. But those structures are still around, right?
Look, absolutely, and we've already used the word pyramid, but it's one of those things. I mean, loans. Private credit is good. Loans are good. You've got to remember we're still talking generally at the top of the capital stack. So the asset class I like. It's just making sure that investors understand what they're getting. These assets will produce income coming off them, so there's always a little bit of income coming out. But unless you're actually getting loans that are repaying during that period, or, as you said, new investors coming in to pay out the old investors, it works until it doesn't.
Yeah, no, that's very true. I can remember that period. Actually, I was just starting at Morningstar, and suddenly all these funds started to lock up, and there was plenty to write about, I tell you that. But it was a very interesting period for sure.
Well, look, I remember it quite vividly. I mean, I was involved in actually looking at some of the hardship requests that came through, and that is absolutely devastating to see that. There were people who had sold their home, and the advisor had told them to put it in this account because it was, it's like a term deposit or it's a cash account, don't worry about it. And then they go to buy a new home and they don't have their money anymore.
Yeah.
Situations where people who had saved a deposit had been saving it because the interest rate was that little bit higher. They'd been saving their deposit there. They couldn't access their deposit. There were situations where people had been putting aside money for their wedding, money set aside for funerals, other family events that were taking place. And when you read the hardships provisions, I mean, that's, it's very tough. And you feel for people who just haven't understood or haven't realised that this situation could happen, that when they do want their money back, they won't get their money back. So it is about, is it right for the person and how much they should have in those kind of structures.
Yeah, and that brings a very sort of practical face to liquidity, because I can also remember, this, the famous book, The Big Short, where they're talking about these investments in subprime loans, and basically they put this trader forward as this genius trader, but his fund's locked up, and he sort of justified it by, well, if you go out now, then you lose all your money, but if you stay for a while, then you make a lot of money. But the investors might have different liquidity requirements. So you can't just tell people like, you're not getting your money back, right?
No. Look, it is just challenging. As I said, I think loans is great. I'm too conservative. It is about, I like loans. I love looking at them. You get to see so many different asset classes. Across my career, working in banks, look, I've done things from hotels to hospitals. I've done feedlots. I've done abattoirs. I've done a catamaran. There's some really interesting things that you can finance, because the reality is you can finance anything, but it is about where it fits into a portfolio.
Yeah. And that brings us sort of to the direct lending business, because you originally joined Cbus in 2016 to set up the direct lending business for the fund. What were some of the main challenges to get this off the ground?
Look, I would say it was very much at the beginning of Cbus's internalisation journey. I probably thought that there would be, when I arrived, that there would be more processes and procedures and things like that in place, the operational background. But Brett Chatfield is very determined and very clear on what he wanted to achieve. So when I arrived, I spent quite a lot of time working with him in terms of, just setting up the whole processes, the procedures, the credit framework, the delegations, the whole process for a credit cycle. I mean, we do have, a credit process and framework, which is, a 40, 50-page document that gets updated each year in terms of making sure that everyone in the team is consistent in how we think about, the debt side of things and what we look for, what you've got to address in your credit manuals or in your credit papers and things like that. So there was a lot of work that was done in putting that in place. But also, you come from a bank, you don't even think about who is going to produce the interest statement for the borrower. Right. Who is going to communicate with the borrower on what their interest rate is. So there was a lot of work with our operations team to make sure that we could actually put those things in place. And of course, don't forget your regulatory things. Yep. All of a sudden you're going, okay, so do we have lending as a designated service on our AML KYC policy? Where are we on the regulatory side of things? So I started in the end of 2016. We didn't write our first loan until the beginning of 2019.
Wow, okay. That's how long it took to set up all the processes.
Exactly. Look, at the same time, and I was looking after the rest of the global credit sector at that stage. And so, you still had your day-to-day, with your managers and things like that going on. But it was very much, we need to take our time in setting this up, thinking about where we want to play in the market and how and when we want to play, I think.
Yeah.
an important aspect of it.
Do you still remember some of those early loans that you made in 2019? I presume the catamaran that you just mentioned was not until later.
The catamaran was back in my banking days.
Okay.
Look, okay, I'll confess, this thing ended up being called the Soggy Moggy.
Why is that?
It was a catamaran that was supposed to sail from Victoria to Tasmania, and it was a deal that State Bank of New South Wales did with, I think, the Bank of Tasmania or whatever. It was a state government sort of initiative, let's say. It was fine. We got our money back because we actually had a put option on that catamaran for it to be sold to a European company that was actually going to sail it across the English Channel. So it was fine, but yeah, that was that would not be something that Brett or Christian or even Lee now would be very comfortable in us putting in the book.
That's unfortunate because I've just got a plumber around who I talked to and is in Cbus, but so I can't tell him he owns a minuscule part of a catamaran. So, but what were some of those early direct loans that you got involved in 2019?
So, things that we got involved in those early days, were things like mainly syndicated transactions. We were very clear that if we were going to do bilateral loans with people in the market, that's really labour intensive. So for us, this is an institutional loan portfolio where we're looking to participate alongside banks in the syndicated loan market. So we're in shopping centres, office buildings, a couple of transactions that we didn't end up doing that we bid on and then were underpriced in. So a couple of those loans are still on our book.
Yep.
Been good performers, very happy with what they've done. They've performed the way that they were supposed to go. But it was slow, but that's what the organisation was really clear. It wasn't about, debt is, especially this type of loans, is not like equities. You can't just go out and buy a ready-made portfolio.
Yeah.
Our aim was to think carefully about what we put on the book, because when you write a loan, you are in the situation that Australia is not a big trading market. You can buy and sell a loan, but not a lot of that takes place. So if you invest in a loan, you have to live with that loan. So it was about making sure that we were cautious about what we got invested in. And at the same time, and the thing that I guess continues to this day is we don't have to write a loan. We would like to grow our loan book. It's an important and we think a valuable part of sort of the global credit sector. But at the same time, if we actually don't see that we're getting good opportunities or good deals to do, the team's not given dollar targets. The team's given a return target and, a long-term objective as to where we see that as a manager weight. So if they're not seeing good deals, and, even recent times, we've seen that. We've knocked back deals, not because they're not good borrowers, but because really the structure hasn't been right and the pricing's not reflected the risk.
You did make some loans during the COVID pandemic, which, probably wasn't that long after you actually started first investing. What gave you the confidence to do that?
Really, that was, I would have to say, Christian was really strong leadership across that period of time. And you've got to remember that what was happening in the superannuation industry at the time, we had early release happening. And my team also manages the cash for the fund. So front of mind, we were seeing all of the requests coming in for early release. But Christian was, this is a time of challenge, but it's a time of opportunity as well. And he was very clear that he wanted us to be, and that's the entire investment team, thinking about what the opportunities were. So I think from that, around about the 20 months from April 2020, we did probably about $1.2 billion worth of investing in the direct debt strategy.
Okay.
we did a couple of residential construction projects where we sort of, we definitely had one transaction which had been knocked back by a bank because of the COVID pandemic and the uncertainty about what was going to happen on construction sites and so on. But we did a couple of others as well whereby, we just knew that you needed to get these things built. Mm-hmm. They were good opportunities. We were comfortable with the pre-sales. We were comfortable with the builders. It was great opportunities to do transactions and provide good, solid returns for the members. And look, it wasn't just loans. We also, our portfolio, has a really broad remit. So we were buying corporate bonds as well at that particular time and getting some fantastic opportunities to get funds invested for the members. So you've got to remember yes, you had members leaving and you had to make sure you were meeting those, but you also had members who were staying and you needed to take care of the returns for them as well.
Yeah, I can imagine with Cbus being, a fund for the construction, that there's a fair few sole traders as well that probably made use of access to the early release and hardship rules maybe because they wouldn't be able to get out and perform their jobs.
Look, absolutely. I think that was consistent across the whole sector. Those early days, you were stopping and trying to work out, well, how many of our members may be eligible for this. And if you remember, some of those rules were really just a self-certify structure. And, a lot of people who were nervous about what was going to happen. And it's about, this opportunity is in front of me. I need to take advantage of it while it's there. Cbus, as well as other funds, have also done the numbers to see what that has impacted on the long run for people from their superannuation balance perspective. But at the time, I guess, that was the right thing for people to do.
Yeah. So Christian Fock was driving some of these initiatives saying, like, let's look for opportunities as well. Was it hard to sell that to the IC and the board? Because it was a very sort of nerve-wracking time.
I think Christian had the support of the board. This is a numbers game. You need to understand your members. You need to understand that book. But it was very important that you don't forget what you're here for. And I think there was very much that steady state. Obviously, the returns in March, April, May, etc. But if you look at the numbers and you see the recovery, you'll see that it happened quite quickly. And if you were too nervous, you would have missed out.
Yes.
So it is about being confident. And Christian and Brett were very good in terms of driving that, staying invested.
And you mentioned during that time there were just certain assets that needed to be built. Can you tell me a little bit about your approach to funding construction projects?
Sure. And look, that were some of the other fun things I've done across my career in banking. In the early days, I ended up in the property team in Sydney, which was quite interesting, and then down here in Victoria as well. So just as background, I've been involved in things like construction of Crown in Melbourne, 333 Collins Street, Dockland Stadium, Park Hyatt. So I've always loved the construction side of things, and I think that was another carrot for me in terms of joining Cbus. The fact that I knew that Brett was very keen that we do participate in the construction space. But I'm an old banker, so we are quite conservative in terms of how we approach construction. And at present, we've got sort of 3 construction deals on our book. One of those is a residential construction, and that has pre-sales in place that cover our debt. So we will do some residential construction deals that don't have 100% pre-sale coverage, and that's a real testament to the internal knowledge that we have within Cbus, because you need to have confidence that you can get this building can be built and that people will buy the product. And so it's really important, some of the internal conversations we do have about any of our construction deals. But just coming back, the other two deals that we've got are actually industrial properties. And they're both ones which are operating businesses, running really well, and they're expanding. And so they've actually got pre-commitments in place to take that additional space. So it's construction that is not speculative. That's not where we're playing. But it's a good, component of our book. We've done construction for social and affordable housing, and that was another one that was done in the depths of COVID. Again, looking at it, we actually had a takeout from our community housing provider to buy that on completion. So we knew that if we could get that finished, we actually had the takeout from a community housing provider who had their debt locked in to be able to buy it.
Yeah. And that's how you manage the risk. So you have this internal portfolio, but you also make still use of external fund managers. How do you think about that mix? Is there sort of an optimal balance between internal and external investments?
From a debt side of things, I mean, the overriding statement is what's in the best interest of the members. So we do have a longer term manager weight, which sees that our internal strategy growing over time. But that's always asterisked with if we can see appropriate opportunities for that portfolio. So we do think having the mix of internal management and world-class external managers is ideal. It enables us that flexibility to make sure we're getting the right return for risk at all times. So we're seeing what our external managers are doing. We're talking to our external managers on a regular basis, and some here in Australia, some are offshore. So we actually have that global approach to how we're investing. So if we were looking at transactions here in Australia and we're saying that just doesn't make sense, we can't see things that make sense, there's no pressure for us to write a deal.
Yep.
We can allocate the money to managers. And I think I see that as really is the sweet spot. It is not that we have to internalisation for the sake of internalisation. It is about getting that right return for the members. But I'll say we do benchmark ourselves. So in other words, we run what are the costs of running an internal strategy compared to what it costs us to get external managers in place. And we're always conscious of that. We talked about some private credit managers before. We get a lot of people who would like us to allocate to them rather than having an internal strategy. And we've seen some really competitive pricing. But it's interesting when you read the ASIC report in terms of fee structures and where things get hidden and all of those. We're very much about transparency. I mean, none of the managers in our credit space are on any form of performance fees or anything like that. It is give us your rate and we will pay that. All of the income on our loans come to the members. There's nothing funny. And we've seen some, let's call it funky structures offered to us, which we sit there and go, this doesn't fit in with RG97. Thanks very much.
What sort of funky structures?
Oh, where they'll take part of the upfront fee, or they will offset fees with other charges and other things that come in place.
Yep.
We're not comfortable with that. And the other thing you have to think of with some of those is we might pay a bit more to somebody else, but I'd prefer to be paying a bit more to have confidence in a manager than other managers who won't charge you very much, but they give you rubbish. That's an easy decision.
Yeah. Rubbish is still rubbish.
Rubbish is still rubbish, and the cost of buying that rubbish and having it in your portfolio the losses that you might incur, in no way can you justify having a slightly cheaper fee but picking up rubbish.
Yeah, no, for sure. So let's delve a little bit deeper into sort of the private credit sector, because it has been very popular. We've just seen the release of that ASIC report that highlighted some questionable practices. I mean, overall they were relatively positive, but I did see some issues there. And an often heard criticism or comment around private credit is, well, it's still relatively new. It hasn't gone through a business cycle, and you don't know, what the level of defaults will be. And I think when we sort of prepared for this podcast, you said, "Oh, it's not that new at all. It's been around forever." Can you explain it a little bit?
Look, absolutely. I mean, we were already talking about a pyramid building society and those and estate mortgages. If you think about it, there's been debenture funds or mortgage funds operating in Australia for at least 30 years. I mean, even if you look at IFM, who've got their specialised credit fund, I mean, that's been operating since 1999.
Yep.
That has been playing in a mix of public and private credit for a very long period of time. You're talking, 26 years now that that's actually been operating. So I think private credit has always been around. And what's my definition of private credit? Very similar to ASICs, and it's basically anything that's not done within a bank. And I actually think there's a need for funding outside of the banks. And you think about why this occurred, and you think about the ASIC report also talks about Australia having about 50% of the private credit is real estate based. And I think that does come back to, the difference between how a housing loan on a bank's balance sheet, what capital you require for a housing loan compared to what capital you require to do, a commercial property loan.
Yeah,
I think that has been a big driver in there being an appetite for people outside of banks to provide the funding. And I think that's a good thing for the market. It's a good thing for the stability of the banks and so on. It is just probably what's become more of focus is where is the private credit sector itself getting its money from.
Yep.
There's obviously institutional investors
From you, yeah.
like super funds. And look, we prefer in that space to choose our own, be selective and choose our own assets and do it directly when we're not interested in having a manager really in that space for us. But I think it has been around for a long time. But yes, there's not been as much oversight of the sector. There hasn't needed to be. The GFC, there was quite a lot. I mean, you had funds at that particular time, LM Finance up in Queensland. I always think of the Queensland Gold Chains White Shoe Brigade. If you look at LM Finance, you look at Storm Financial, you look at any of those names, you'll see these same patterns repeating themselves.
Yeah, I remember Storm Financial. I think we wrote about that for years. that was a big one.
Exactly.
But it also at this time, I think part of the reason why the report also came out is what we talked about earlier. There is now participation from retail investors into the private credit space, and so new vehicles have been constructed that live on advisor platforms, and they tend to have daily liquidity. And back to the old mortgage funds, like there's only a couple of ways to provide that liquidity, and it doesn't come from the underlying assets. So do you worry about seeing sort of this increased retail participation in the private credit space?
So I guess where I sit, I am slightly removed from it. I worry about the retail investors. I mentioned the days with AXA. But it probably even goes back to my days being on the counter and seeing people come in every second Thursday to cash their pension checks. There are a lot of people who are relying upon income and want their return. And I worry about that side of things. I worry about the potential flow-on effects. There are good lenders out there, but it is about, is the product matching? Are the way they're funding it appropriate? That would be sort of that biggest question.
What are some of the other concerns that you have in regards to private credit funds? I understand that some of them might have some leverage in them.
That's a good question. That is certainly a trend that we are seeing. There is a lot of debt that's been put into these funds, also known as a NAV loan. On the positive side, it can help the manager to smooth the cash flows and possibly boost the returns in the investors. But on the downside, that debt ranks in front of the investor. So I worry that's not fully understood by wholesale investors. There could also be some risks for institutional investors who support a manager that offers a wholesale product. In this scenario, you're likely to see loans being shared across the platform, across the wholesale and the institutional investors. So how are decisions being made on those underlying loans in a scenario where the fund manager is needing to get loans or part of the loan repaid as quickly as possible to meet redemptions, yet the institutional investor might have a more patient time frame?
Yeah.
Where we are in the current environment is often the products are not paying a lot more than, say, a term deposit or something. So people are looking at them and going, well, that's only a little bit more. That's obviously not much riskier. It must be okay. And I think that distorts the fact that some of these structures are there's a level of fees and expenses and things like that are coming out before the investor actually sees their return.
Yeah.
So they're not seeing that in reality, if they were getting a pass-through of all of those things, their return would be a lot higher. Alternatively, and this is where the market is very, very competitive on loan transaction at the moment, is are people pricing risk properly?
Yeah.
And that's where it starts impacting, say, on us and the transactions that we're doing. At the moment, there's a lot of competition in the Australian space. You've got foreign investors, institutional investors here. You've got a lot of the foreign banks here, and you've obviously got your private credit funds, your Australian banks. Australia's a small market. There's not a lot of transactions. So you are actually seeing people competing to do transactions.
Yeah. Does that have sort of a flow-on effect in the sense that underwriting standards might drop a little bit, margins coming in? Does that have sort of that cascading effect?
It absolutely does. And so that's why that's where it does impact us. We do see that. We're in syndicated deals, so we're seeing who's in those deals and who's in those transactions. There's been a number recently, in the last few months, whereby we've knocked back participation in a transaction. Not, it'd be a good borrower, but the pricing for the way it's been structured, and when I mean structured, the covenants that are in place looser than they should be.
Right.
And that might be okay. The borrower might not do the wrong thing, but they're very loose covenants and the pricing is low. And we can look at that and we just say, look, thanks, we won't participate in that transaction. So the team's really quite disciplined. We've got a broad group of people in that team now with broad experiences and things like that, but no one feels the pressure they just want to do, good transactions and that are appropriately priced.
Yeah. So do you see more of that happening? Do you see more loans where you think like, I'm going to skip on this one?
Some of those are easy decisions. Where it gets harder is where, look, you're always going to want the loan to pay you a little bit more than what it does. I mean, that's borrowers always want to pay less, and lenders always want to charge more. So there's a space where that is really a clear decision. And there's borrowers whereby, you're prepared to give them a little bit of a leeway because they're good operators and things like that. But there's other transactions where you just say that doesn't make sense for where we see that risk or the potential risk of that transaction. We'll walk away. And again, because we don't have to play in one space. I always think back to the days when I worked in the bank. If you're in the property section of the bank and the bank says, we've got enough property, you're not doing any more, what are you going to be doing? If you're in a credit fund and credit returns are not looking good, what are you going to do? You've got investors that have given you money that want to get invested. It's quite a challenging. It takes someone very strong who is earning their money on funds under management to say no thanks to the funds. Whereas that's not a challenge that we have at Cbus, because I can look at credit managers and allocate to them, or I can sit down with Justin Pascoe and the asset allocation team. We can talk about credit markets generally, what we're seeing, the themes, and we just think about, well, do we want to go underweight credit at this particular time? How do we want to position ourselves? You just got to maintain your discipline.
Yeah, for sure. And you do come at it from a different angle than I think a fund manager as well, because you're investing for members in sort of a context of a multi-asset portfolio. And I think you've stipulated that the credit part of the portfolio, the fixed income part of the portfolio, it's not a standalone option. It's part of the multi-asset portfolio. Does that make you look different at how you invest in credit and in certain transactions, with that idea that maybe more a diversification lens rather than a pure credit lens?
Look, absolutely. It is when our members invest, majority of our members go with one of the pre-mixed options.
Yeah.
Okay. And so all of your pre-mixed options, most of them will have some exposure to credit. But as part of that overall portfolio, our total credit component might be 6 or 7% of it. So it's not a significant component in the first place. They have exposure to equities, infrastructure, private markets, and so on. Where credit does cross over is the fact that if we are in public credit, it's tradable. Sometimes it's not tradable when you want it to be tradable, but generally it's tradable. It's like equities. It trades like equities. But on the private side, you have to be conscious that you're actually using some of the fund's illiquidity budget. So when we do private credit, whether we do it in-house ourselves or via a manager, we are conscious that we are making that long-term commitment. We're allocating money to something that may not pay us back for 3 to 5 or 7 years' time. And so we actually treat that as an illiquid asset. So we expect it to give us a premium over a liquid asset. We also, when we look at the overall sort of risk side of the fund, we do take into account that is illiquid. So we sit down with the private markets team. We're having discussions all the time about how we think about our illiquid component of the portfolio.
Yeah.
So it's got to compete to an extent with other illiquid assets, whether it is the property, the infrastructure, private equity.
Yeah, that makes sense. So last question, what is on the calendar for the rest of the year? Do you have any research projects coming up, any reviews of sectors?
Look, it's really a business as usual time. The sectors we think are well set up, and we talked before about the fixed income sector. Our fixed interest sector is just the govies, so that's where we make our duration call. Our credit sector is just credit, and it is predominantly floating rate credit. But those sectors are set up well. We're happy with the managers in it, but it's a matter of monitoring and just continuing to make sure that they're fit for purpose and set up the way that we want. On the internal side of things, we're keen to do some more construction deals. We like to think that there's going to be a bit more movement on, in particular, residential construction over the next year or so. So there's a focus there. And the team obviously we've been working on the social and affordable housing side of things. We'd be keen to be involved in that space. That's been particularly challenging, but it's a continual head down and see what we can do and see if we can make it stack up.
Yeah. What's the interest in affordable housing? Is that from a credit perspective, or is there that element of ESG to it?
Look, it's predominantly from a credit perspective, but we do think of it as sort of, if we can make it work, it's a win-win-win. So we need to get fundamentally returns for the members, and we think that's why debt makes sense. We're not sure that equity, especially in social and affordable housing, is the way that we want to play. But for debt, you can get an appropriate return for your risk. We'll look at doing it. But also the construction side of things. If we can create jobs for the members, that's also a win. And the third point really is that societal. There is a need for more housing across the board, but in particular in that social and affordable space. So if we can support that, we're very keen to do so.
Yeah, absolutely. Yeah. Well, Linda, thank you very much. That was a fascinating conversation. So thank you very much for your time.
Thank you, I appreciate the opportunity to talk to you.
Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3-invest.com. And don't forget to like, subscribe and review. Thank you very much.